The Indian stock markets experienced a significant downturn today, with both the Nifty and Sensex declining considerably. Now, if you see the image on your screen, both the benchmark indices Nifty as well as Sensex have declined by more than 2% each. Now, the indices have witnessed a broad-based slump across all sectors, as you can see on the screen. Now, with the decline, the market cap of all listed companies has also declined by more than 10.5 lakh crore rupees. Several factors have contributed to this slump in the market. So stay tuned till the end of the video to understand the reasons behind the sharp fall. Now, first is the Israel-Iran war escalation. The first and the most significant reason is the ongoing war between Israel and Iran. While the Israel-Palestine conflict has been going on for several decades, it intensified in the month of October 2023. And while this is still ongoing, the conflict did not stop there. Countries like Yemen, Lebanon, Iran and Iraq have countered Israel, and a bigger regional war has now escalated. So recently, Iran fired a barrage of around 200 missiles at Israel on 1st October in retaliation to the killing of Hezbollah's Hassan Nasrallah. Israel has vowed to make Iran pay for the attack on its territory, with Tehran warning it would launch an even bigger attack if it is targeted. Now, this escalating conflict between Israel and Iran has introduced a new layer of uncertainty into the global geopolitical landscape. Now, as tensions rise, investors often become more risk-averse, leading to a sell-off in the equity markets. Now, the fear of a potential escalation and its implications for regional stability and global oil supplies have weighed heavily on the market sentiment. Next is the uncertainty around the crude oil prices. Now, with the worries of a further escalation in the Middle East, crude oil prices have started surging. Brent crude has come to a near $75 per barrel mark, but more importantly, it has surged by more than 5% in the last 5 days. But let me explain this in a very simple way. The Strait of Hormuz is the most important oil transit choke point in the world as per the US Energy Information Administration. It is super important as large volumes of oil flow through the Strait of Hormuz, connecting the major oil-producing countries like Iran, Saudi Arabia, Qatar, Iraq, Kuwait in the Persian Gulf to the refiners across the globe. And the top destination for the crude oil moved through these paths are China, India, Japan and South Korea, accounting for 67% of all the crude oil passing through the Strait of Hormuz. While Russia still remains the top source of crude oil for India, accounting for $14.79 billion worth of oil imports in the first quarter of FY25, India still depends for a significant part of its energy imports through the oil that is passing through the Strait of Hormuz. Now, 2/3 of the oil and half the LNG India imports come through the Strait of Hormuz. Now, we all know that a rise in oil prices is a negative for the importers like India, as crude contributes significantly to the country's import bill. Moreover, higher oil prices can lead to increased input costs for businesses and consumers, dampening economic growth and reducing the corporate earnings collectively. Now, as a result, investors may become more cautious about investing in equity markets, fearing a potential slowdown in the economic activity. Third is the SEBI's move to tighten the F&O. Now, measures in a bold way, the Securities and Exchange Board of India has announced a slew of measures to tighten rules in the futures and options segment. SEBI has announced 6 measures, but the notable one are the increase in the minimum contract size in the derivative market to rupees 15 lakhs from the current levels of rupees 5 lakhs. Now, other measures include upfront collection of option premium, the removal of calendar spread treatment on the expiry day, intraday monitoring of positions limit, increase in the extreme loss margin coverage on the day of options expiry, and lastly, limiting weekly index expiry to only 1 per exchange. Now, all of these measures have dampened retail sentiment and could lead to a drop in the volumes by as much as 50%. Now, this uncertainty around trading dynamics has likely fueled investor concerns, adding to the market's downward pressure and amidst the broader geopolitical tensions. Lastly, the Chinese economy has been facing some serious problems of declining exports, slowing in the property sector, muted consumption growth, and rising unemployment. Now, with all this at stake, the Chinese central bank recently announced a cut in the borrowing costs and an injection of more liquidity into the economy. Now, this was done to stimulate and revive the Chinese economy, which has witnessed subdued growth ever since the pandemic. Now, this has led to the Shanghai Composite Index jumping by over 20% in the last 5 days. Now, this is actually the fastest surge that it has ever seen in over more than a decade now. While this is good for the Chinese economy, it's slightly negative for the Indian economy. Foreign institutional investors have withdrawn more than 15,000 crore rupees from the Indian equities in the last 2 trading sessions, alone adding to this decline. Now, all in all, the recent decline in the Indian markets can be attributed to a confluence of all the factors, including geopolitical tensions, rising crude oil prices, tighter regulations by SEBI, and the ripple effect of the Chinese economic recovery. Now, as these factors continue to evolve, it is essential for investors to stay informed and monitor market developments closely. While the short-term outlook may appear challenging, India's long-term growth prospects remain promising, and the current market downturn may present opportunities for long-term investors like you and myself to accumulate quality stocks at attractive valuations. With that, this is Raj Mehta signing off, wishing you and your loved ones the very best. Thank you.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.